Welcome back to The Explainer. Today, we're breaking down the massive geopolitical shift from May 7, 2026, and exactly what it means for your wallet. We are looking at a fascinating, real-time case study of just how interconnected our global economy really is.
So let's dive right in by asking the billion-dollar question that connects global diplomacy straight to the Indian stock market. How on earth does a single one-page document, drafted literally on the other side of the planet, manage to ignite a trillion-rupee rally on Dalal Street? It sounds crazy, right? But to understand this, we've got to look past the flashy headlines and follow the money, the oil, and the supply chains.
To do that, we're going to map out this domino effect in 4 quick steps. The US-Iran peace framework, unlocking India's energy choke point, Dalal Street's massive rally, and finally, navigating future volatility. Let's start right at the top with Section 1, the US-Iran peace framework, and negotiating an end to the West Asia conflict. The sheer scale of this 14-point memorandum, it's honestly staggering. Negotiated by U.S. envoys Steve Witkoff and Kushner via regional mediators, the core of the deal pushes for a double-sided ceasefire and a phased lifting of economic sanctions. But look closely at the sticking points here. The U.S. wants a 12 to 15-year moratorium on uranium enrichment, while Iran is countering with 5. And, absolutely crucial for global trade, there's a clause for unimpeded freedom of navigation through the Strait of Hormuz, kicking off with a 2-week safe passage window. Now, to remain completely impartial here, we have to note that this ceasefire is highly conditional. The U.S. president issued a very strict 48-hour ultimatum for Iran to formally accept these terms, warning that without an agreement, military operations would resume at a much higher level and intensity. It's a high-stakes diplomatic tightrope, and the entire global economy has basically been holding its breath, waiting for Iran's formal response.
So why does New Delhi care so much about this specific framework? That brings us to Section 2, unlocking India's energy choke point, and why the Strait of Hormuz is India's energy jugular.
Listen, the Strait of Hormuz isn't just some shipping lane on a map, it's India's energy jugular. The blockade of this waterway put an absolute stranglehold on the country's essential energy supplies. Just look at these blockade numbers. A massive 91% of India's liquefied petroleum gas and half of its liquefied natural gas imports, which mostly come from Qatar and the UAE, were placed under severe duress. We are talking about the literal fuel that powers Indian industries and cooks food in millions of homes. The contrast between a wartime economy and a peacetime economy for India is incredibly stark. During the height of the blockade, the Indian government actually had to invoke the Essential Commodities Act. They were forced to prioritize household cooking gas over critical petrochemical production just to maintain domestic stability. But then, shift over to the ceasefire reality. The easing of tensions means supply chains unfreeze, and those immediate crushing inflation fears finally begin to subside. Just how fast did the market react to the shift? Well, the mere news of this potential peace deal sent global Brent crude prices crashing down by 11%. This was a huge drop that brought oil back down to the critical sub-$100 a barrel threshold. For an oil-importing nation like India, an 11% drop in crude isn't just a fun headline. It's an immediate, massive reduction in the national import bill. And that huge drop in the energy risk premium instantly triggered the tertiary effect. Let's look at Section 3, Dalal Street's massive rally, and the market's euphoric reaction to easing tensions. Dalal Street reacted with, frankly, absolute euphoria. The BSE Sensex surged an incredible 941 points in a single trading session, slicing right through the previous weeks of anxiety to close at a robust 77,958. It was a crystal clear signal that the domestic market was ready to sprint the second those geopolitical brakes were released. And the Nifty 50 mirrored that exact same optimism. It climbed nearly 300 points to settle at 24,330. To put that into perspective for you, this marks the index's strongest single-session gain since mid-April. The market shifted almost instantaneously from a defensive, hedging-dominated posture right into a momentum-driven rally. And as you'd expect, a rising tide lifts specific boats very quickly. Analysts pointed out breakout stocks that really stood to benefit from this renewed buying interest. Sumit Bagadia over at Choice Broking highlighted several names right off the bat, including Wellspin Living, BLS International Services, Gujarat Fluorochemicals, Jubilant Angrovia, and Karur Vysya Bank. Money is rapidly flowing right back into mid and small cap pockets as risk appetite returns. But wait, it wasn't just domestic retail money driving this whole shebang. With crude oil cooling down, the Indian rupee strengthened. And this stronger rupee completely changed the math for foreign institutional investors, finally incentivizing them to reverse their persistent outflows. For the very first time in May, FIIs became net buyers. This is a super crucial metric. Foreign capital returning adds a structural backbone to a rally that domestic investors alone can't always sustain. However, it's not all clear skies just yet. Let's move to Section 4, Navigating Future Economic Volatility, and what investors should be watching next. Let's look at the timeline to see how this builds into actual actionable steps. These are the strategic triggers that will dictate the market's true direction. First up, that immediate 48-hour window for Iran's formal response to the MOU. Second, looking out over the next 2 weeks, the market needs visual confirmation that commercial vessels are safely navigating the Strait of Hormuz. And third, zooming out to June 2026, we've got the highly anticipated Reserve Bank of India monetary policy meeting. Speaking of the RBI, man, talk about a tough day at the office. Even with a peace deal on the table, economists predict the central bank will actually hold interest rates steady in June. They have to carefully execute a balancing act, managing what HSBC's chief India economist called a double shock, basically navigating the lingering effects of high energy prices while simultaneously dealing with the potential impact of El Niño on domestic food inflation. I think this quote from V.K. Vijayakumar, chief investment strategist at Geojet Investments, really hits the nail on the head here. He notes that the market is swinging between hope and fear, and this might continue until there is a definitive conclusion to the crisis. Because until the ink actually dries on that document and those ships are moving freely again, the market remains entirely dependent on real-time diplomatic headlines. So we are literally watching in real time how deeply intertwined global geopolitics are with our domestic economy. The dominoes have fallen from the Middle East straight down to Dalal Street, leaving us with a massive long-term puzzle to solve. Which brings us to a huge final question to chew on. If this 14-point US-Iran peace framework holds, and the Strait of Hormuz permanently reopens, will India's energy risk premium disappear entirely? And if it does, how might a permanent ceasefire fundamentally accelerate India's long-term economic growth story? That is exactly what we'll be tracking closely over the coming weeks. Geopolitics move incredibly fast, and we want to make sure you stay ahead of the curve. So please like, share, and subscribe to this explainer, and definitely drop a comment below. Let us know how you think this peace deal will impact your own portfolio. Thanks so much for joining us, and we'll see you in the next one.